Welcome to Shark Cap Table Fast, the 1-minute deal maker for sellers and buyers of equity that helps you keep your arms and legs. Today, instead of selling and structuring a company, we're going to actually be in the business of possibly buying one. So I'm going to come over here and I'm going to select Buy Shares. We're still going to have investors and we're going to hide all the help. Now, in the turquoise here, it already tells you buying shares used fast to analyze and determine fairness before purchasing a private placement or crowdfunding deal. Now, you're going to see that there are some numbers already placed in here, but I want to alert you that they come from a table below. So here, you've been offered shares in Whizbang Corporation, a privately owned company seeking expansion capital. And again, there's a repeat of this turquoise, with one exception that says obtain a copy of the selling brochure and dig into it. That's a must because the numbers just aren't going to jump out at you. So the first thing that we've done is we've entered some data that a typical deal over the telephone or somebody's offered it to you consists of 50 units at $10,000 a unit. There are 5,000 shares in a unit and the unit share price calculates out to be $2. There are attached warrants per unit of 5,000, and they have an exercise price of $1.50. Now, from the offering brochure and questions aimed at the promoter, we find out that there's been $50,000 worth of cash invested, that there's about $500,000 worth of Whizbang additional value. That is our assessment, not theirs. And that gives about a total of $550,000 founders valuation or Whizbang total valuation. Now, Whizbang's got 1 million shares outstanding. They have another 500,000 existing options, warrants, and convertibles. Very important that you get that number. As you could see, that could amount to a substantial amount of dilution. And oh yeah, Whizbang guys tell you that they're going to sell in 2 years for a big number, $10 million. So ultimately, they've raised from the units $500,000, and sometime in the future, the warrant exercise will cost $375,000. And of course, all of this is for the entirety, not the individual unit. We have some more summaries down here, but we're not going to go through those. You can read them later. So let's go back up and see what's really going on. As you see, some of these numbers have already been entered. You cannot use the spinners on these. So here your cash investment, the additional value, the Whizbang total valuation, the number of shares, and we do have to enter these. So here we have a number which is telling us that we need to spin in until we reach $500,000. Oh, no, 500,000 warrants. There we go. So there's 500,000. Now, we need to come over here and we need to make this number here 10 million. Because that's what is showing and that's what the sale price is expected to be. We need to put 2 years in here. We need to make 500 show below in the blue. So there we are. We're coming up. Doesn't take long. There we go. Now the last thing we have to do is we have to make this number here equal to $2. So we're going to spin that. It takes a while because it's basically way overpriced. There's $1. We're still going. We're approaching $2 down here, $1.80, $1.90. There it is, $2. We got lucky. Sometimes it's not exact. Same thing over here. Sometimes that is not exact. So now what do we have here? Let's go through the fully diluted ownership. 25% are owned by the Whiz options. Founders have 50% in the units and the warrants. We assume that warrants are exercised right before the sale. So coming over here to the investment multiple, the founders have 100 times their money and the unit warrants have 2.9. Again, for the internal rate of return, the Whiz founders have 900%. The unit holders have 80%. The voting control prior to the exercise of the warrants is 80-20 in favor of the Whiz founders. Okay, well, wow, how about that? Most people are mesmerized by this number here. Well, let's see what happens when things go badly. Look at 80%. Let's say it takes 4 years. Ooh, we just chopped off more than half. Let's say we only have $6 million. Whoa, what happened here? well, all these fabulous returns are just vaporizing. And it's all because we have this huge pre-money value. Look at the difference here, folks. If you've played around with sell in Shark Cap Table Fast, you will know that even though we try to make this big, the investors are almost always going to be less. But here we have a promoted deal that is 6 times or 5 times what this number is. So something is radically wrong. And it's because of this huge number that there is no protection on the downside. You get a slight reduction in what happens and you're hosed. So now watch what happens if we brought this down, even with these lousy numbers, okay? Watch what happens if we brought this thing down to around the $500,000 level, which is where it probably should be. Now it becomes reasonable. 3.7 and a 43%. And of course, watch what happens if you get lucky and you actually get what they say. Yeah, baby, there it is. So, the bottom line is promoters always have too much value in their pre-money value. And they always justify it by having a horrendously large founder's valuation. That is why we want you to pick out the details and understand exactly what the value of the company is and then compare it to what they're saying it is. And the way you figure that out is you generate the price per share that they will be selling it to you for. And of course, this price is different because it should be 2, and the only way you get 2 is by making this over 3 million or 4 million, whatever it was. Now here we have the summary of investment units with attached warrants. And of course, the numbers and the words here are all linked to these areas here and these areas here. Without further ado, you have now learned how to analyze a deal when it is placed in front of you. And the bottom line is almost always the pre-money value that is given to you is way more than the actual valuation of the company. Almost always the pre-money value is in excess of what the real value of the company is. And that's why we break this down into 2 parts so that you can see the difference. Most people just talk about pre-money value. I want to make sure that you understand that there's some real estimates going on in a company and that the pre-money value may be higher or lower than the real founder valuation. Thank you very much.